Well, in response to changing economic circumstances, many of our viewers' companies are constantly reevaluating their portfolio of business and continually testing for strategic fit and for return on investment. What happens when they conclude that they must carve out a particular business for eventual disposition?
Quite a lot, Mike. I'll limit mostly the scope of my comments to the tax world, but it is true across the board. You got to know what you're selling. Otherwise, you're going to get it beat up on price, on due diligence, and perhaps on structure and tax cost if you don't put in the time before the investment bankers take this out to potential buyers. The financials you're going to get. You've got to do work to put together the data room so that that's all ready for the buyers. But on structure, you want to know, can we offer the buyer, for example, a step up in tax basis, which they will want if we can offer it? And if so, is there going to be a cost to the seller? If it's a divestiture, in many cases there won't, but in many cases there will. We'd like to be able to offer that, and we don't want to have to scramble on a question like that after a buyer asks about it, and we're already in the process. If we need to restructure a little bit, we need to know about that. If we care about purchase price allocation, likely we're selling a domestic business, but some foreign pieces as well, we may care how much is allocated to the German sub or the Italian sub, and we need to be proactive and prepared.
Of course, our viewers might see it in connection with the carve-out financial statements, but I suppose you've got to calculate and report the deferred tax assets, or so-called DTAs, associated with the company's attributes, such as net operating losses, don't you?
Thanks, Mike, for bringing that up. So I glossed over the financial reporting aspects, not least because not my forte, but the carve-out financial statements, if you don't have a pre-existing set of separate financials and you're doing a full carve-out, that can take months and months, and that has to be anticipated to be part of the process, and people will anticipate to be part of the process. DTAs in particular associated with net operating losses, or perhaps a significant difference between tax basis and fair value, important, and trying to see what stays in the group, what leaves the group. You don't have a choice about that. We have limitations that will come into play after an ownership change. I would say more frequently in my experience, though, where the DTAs are a major issue, less commonly in a corporate divestiture, much more frequently where we're a company and we're acquiring a freestanding, maybe entrepreneur-led business, often with venture capital backing, where they've run up a bunch of NOLs, not because they're financially challenged, but because they're expensing the quote investment that's built up the value. And then we have owner shifts taking place every time they have a new round of venture capital financing. So trying to get our arms around that in tax due diligence to see what it's worth, has there been an ownership change, what limitations are in place, is an important piece of work when doing an acquisition.